Part 1. Introduction. We often say that in football, the ball is round, implying that the outcome of a match is unpredictable. However, when viewing the European football market through the lens of capital, a completely different reality emerges. A cold-blooded financial game where the results are calculated and the winners are often predetermined. Recently, European football has become a massive hunting ground for US-based private equity firms. While the public and media often generalize these entities simply as wealthy American owners, such a description fails to capture even half of the phenomenon. We must categorize this capital into two distinct archetypes: the builders and the sharks. To illustrate the difference, let's use a real estate analogy. Imagine purchasing an aging commercial building in a prime district. On one side, you have the builders. These investors purchase the building with their own equity. Their goal is to remodel the property, secure blue-chip tenants to increase valuation, and eventually sell it for a profit. Clearlake Capital, owners of Chelsea FC, and Redbird Capital, owners of AC Milan, fit this profile. As owners, they act as principals who desperately need the asset to succeed. On the other side, you have the sharks. These investors do not buy the building. Instead, they lend money at high interest rates to a landlord facing liquidity issues. If the landlord defaults, they seize the entire building held as collateral. Oaktree Capital, which swallowed Inter Milan, operates with this precise methodology. Unlike the U.S. sports market, where strict regulations typically limit private equity to minority stakes, Europe acts as a Wild West, a regulatory vacuum where capital can acquire 100% control or seize clubs through debt enforcement. In this session, we will dissect the collision of these two capital types in the European football market through three lenses: mechanics, precedents, and incentives, uncovering the structural inevitability of why prestigious European clubs are being converted into portfolio assets for U.S. capital. Part 2. The mechanics, equity buyout versus debt seizure. In this section, we analyze the legal and financial engineering used to seize control of these clubs. Behind the simple headline, "The owner has changed," two completely different capital transmission mechanisms exist. First, the builder's method, equity buyout. This involves the deployment of risk capital and a value-up strategy. Traditional private equity firms like Clearlake, Redbird, and Bain Capital follow a clear approach, securing ownership by acquiring 100% or a majority stake in the club. Regarding capital structure, they utilize funds committed by limited partners to provide cash to existing shareholders and purchase equity. For example, in the acquisition of Chelsea FC, while Todd Boehly acted as the frontman, over 60% of the acquisition capital was sourced from Clearlake Capital's funds. This represents a typical joint governance structure or majority control model. Regarding regulatory approval, this method requires passing the owners and directors test, administered by leagues like the Premier League or Serie A. While the process is rigorous, requiring transparent proof of funds and clear criminal records, once passed, it grants legitimate, total decision-making power over the club. Finally, multi-club ownership. These firms rarely stop at one club. Look at Redbird Capital. While acquiring AC Milan, they also hold a stake in FSG, the parent company of Liverpool FC. Similarly, Ares Management is involved with Lyon, Crystal Palace, and Atletico Madrid simultaneously. This applies modern portfolio theory to sports, hedging the risk of one club's underperformance with another, or creating internal transaction efficiencies by moving prospects between affiliated clubs at below-market rates. Second, the Sharks method, loan to own. This utilizes default as a trigger for a bloodless entry. This is the core of today's analysis and arguably the most formidable scenario. Distressed debt funds like Oaktree or Elliott Management do not initially declare an intention to become owners. Their entry strategy is the lending. They approach owners in financial distress. A prime example is the Suning Group, former owners of Inter Milan. When their finances deteriorated due to COVID-19, Oaktree lent them approximately 275 million euros. Crucially, this capital carried an interest rate significantly higher than standard commercial bank loans. The pledge, or collateral. In exchange for the liquidity, they executed a share pledge agreement. The clause was simple: Failure to repay results in the transfer of 100% of the club's holding company shares. While rare in U.S. sports, this structure is viable in Europe. Execution, the seizure. In May 2024, upon maturity, Suning Group failed to repay. Oaktree immediately enforced their security interest. Complex acquisition negotiations or due diligence were unnecessary because the valuation was already assessed at the time of lending. Without paying an additional cent in acquisition costs, simply by foregoing the principal and accrued interest, Oaktree became the owner of Inter Milan, a club worth billions. This is the quintessential loan-to-own strategy, starting with debt and ending with equity. Third, the aggregators method, league-level investment. This strategy focuses on risk hedging, eliminating the performance risk of individual clubs. CVC Capital Partners is known as the master of sports bundling in the private equity world. They are indifferent to who wins the league or who gets relegated. Their thesis is simple. Regardless of the match results, the games will be played, and broadcasting rights fees will be generated. Therefore, they acquire the commercial rights of the entire league. Deal structure, the carve-out. CVC does not lend money directly to the league association. Instead, they mandate the creation of a new commercial entity dedicated to managing broadcasting rights and sponsorships, and then acquire a stake in this specific entity. La Liga, Spain. CVC invested approximately 2.9 trillion won to acquire an 8.2% stake in the new commercial entity. The contract lasts for 50 years. This means that for the next half-century, 8.2% of all commercial revenue generated by La Liga will flow into CVC's pockets. Ligue 1, France, LFP Media. They invested roughly 2.2 trillion won for a 13% stake in the commercial subsidiary, LFP Media. Unlike Spain, this deal is perpetual, effectively making them a permanent landlord of the league. Capital control mechanism, the 70-10-15 rule. CVC didn't just hand over the cash. To prevent clubs from squandering this liquidity on transfer fees, they imposed strict covenants on the use of funds. 70% for growth capex. Funds must be used for long-term asset value enhancement, such as stadium renovations and digital infrastructure. 15% for deleveraging. Funds must be used to repay existing debts to improve financial health. 15% player cap. Only 15% of the capital can be allocated to player signings, transfer fees, or salaries. This represents a structural attempt by financial capital to control the lax management typical of sports clubs. Fourth, the Desperates method, future revenue securitization. Often referred to as Barcelona's levers, this is a classic asset securitization technique, selling the future to buy the present. FC Barcelona faced a situation where additional loans were impossible due to debt limits, and selling equity was prohibited by their member-owned socio-structure. Sixth Street proposed a solution, the pre-sale of future receivables. The mechanism. Barcelona signed a contract transferring 25% of their La Liga broadcasting revenue for the next 25 years to Sixth Street. In return, they received an upfront cash injection of approximately 700 billion won in financial reality. While the club packaged this as investment attraction, financially it is no different from high-interest debt. 1/4 of their most reliable cash flow, broadcasting fees, has evaporated. This is akin to a corporation factoring its accounts receivable at a discount. It is a desperate measure that sacrifices future growth potential to secure immediate survival. Part 3. The precedents. The capital raid currently unfolding in the European football market is without precedent. However, by comparing it to past cases, the trajectory of current deals becomes much clearer. First, Elliott versus Oaktree. The recurring history of distressed investing. The resurrection of AC Milan versus the uncertainty of Inter Milan. The seizure of Inter Milan by Oaktree mirrors the case of Elliott Management seizing AC Milan in 2018. Comparing these two provides a perfect leading indicator for how Oaktree will handle Inter Milan. The precedent, 2018, AC Milan and Elliott. When the Chinese owner Li Yonghong defaulted on his loan, Elliott immediately seized control. They cleaned up the balance sheet by offloading overpaid players and restructuring the squad around efficient, young prospects. 4 years later, they sold the financially healthy club to Redbird Capital for $1.2 billion, realizing a massive profit. This is a textbook private equity turnaround and exit strategy. The current case, 2024, Inter Milan and Oaktree. With the Soning Group's default, Oaktree has taken control. The market is asking, will they operate it or sell it immediately? It is highly likely they will follow Elliott's playbook. Football club management is not Oaktree's core business. Rather than a fire sale, they will likely spend 2 to 3 years overhauling the financial structure to maximize its value as an asset before listing it on the market. For Inter fans, this implies that fiscal austerity and efficiency will be the guiding principles for the foreseeable future. Second, U.S. minority versus EU control, regulatory arbitrage, unlocking in Europe what is forbidden in America. If you look at the capital flooding into Europe, Clearlake, Redbird, Ares, Sixth Street, Silver Lake, Oaktree, they are all U.S.-based. Why did they head to Europe instead of their domestic sports market? The reason lies in the cartel structure of U.S. major leagues, NFL, NBA. Owners have historically banned private equity buyouts to protect their exclusive club. While regulations have recently loosened, severe restrictions remain, such as allowing only passive, minority investments without voting rights. For private equity firms used to driving returns through active management, this is a frustrating market. In contrast, Europe is a wild west. If you have the capital, you can do anything. Buy a Chelsea FC outright and overhaul the entire roster, or purchase the commercial rights to an entire league. Therefore, the current U.S. capital invasion should not be interpreted simply as European football being attractive. Instead, it is a phenomenon of regulatory arbitrage. Europe serves as the only outlet where U.S. capital can satisfy its appetite for full managerial control and buyouts. Part 4. The incentives. Why now? Having examined the mechanisms and precedents, we must answer the fundamental question. Why now? We analyze the precise moment where the interests of U.S. capital and European clubs intersected, the combination of a valuation gap and a liquidity crisis. First, the buyer's incentive. Valuation arbitrage. Buy global IP at 20% of U.S. prices. The primary reason U.S. private equity firms are flocking to Europe is simple. It is cheap. From a financial perspective, the valuation multiple gap between U.S. sports and European football is irrationally large. U.S. franchises in the NFL or NBA typically trade at 8 to 10 times revenue. In contrast, globally recognized European football clubs trade at 2 to 4 times revenue. The private equity calculus is clear. They believe European clubs are undervalued due to under-commercialization. Their strategy is to acquire these assets cheaply, transplant U.S. business models, such as the Yankees media approach, to boost profitability, and then exit by applying U.S.-level multiples. Redbird Capital's partnership with the New York Yankees upon acquiring AC Milan aligns perfectly with this logic. Second, the seller's incentive. Desperate measures for survival. Bankruptcy or selling the future? Conversely, European clubs and leagues swallowed their pride and shook hands with private equity due to sheer desperation. The League One case. The reason the French league surrendered a perpetual 13% stake to CVC was a severe financial crisis. Amidst COVID-19 revenue losses, their broadcasting partner MediaPro went bankrupt, halting payments. The league faced imminent financial collapse. The lifeline. The $2.2 trillion offered by CVC was not merely an investment, it was a ventilator. CVC leveraged this negotiating power to secure a permanent share of the league's commercial subsidiary. Craving stable cash flows. For CVC, investing in individual clubs carries too many risks, such as relegation or player scandals. Investing in the league ensures a guaranteed cash flow from broadcasting rights regardless of who wins. This is why CVC relentlessly pursued league equity despite fan protests involving tennis ball bombardments. Part 5. Strategic implications and future outlook. We now forecast the impact of these deals on the European football market and the broader global sports finance landscape. First, the trap of leverage, a future without growth. We must pay attention to the current situation in French Ligue 1, where the rosy outlook of the CBC deal is fading. CBC justified their investment by promising to maximize broadcasting rights through their network. However, the 2024 negotiation results were significantly lower than CBC's bold predictions. The reality: revenue did not increase, yet clubs must now perpetually pay 13% of all incoming revenue to CBC. The worst-case scenario. For the clubs, the worst-case scenario, losing equity without seeing the promised growth effects, is becoming reality. This will likely serve as a stark warning to other leagues considering the CBC model, putting a brake on its expansion. Second, polarization of capital, the rich get richer. European football will no longer be a competition between nations, but a war between capital types. Tier 1, sovereign and mega PE. Clubs like Man City, PSG, and Chelsea, backed by sovereign wealth funds or massive PEs, will continue aggressive investment even while sustaining losses. Tier 2, self-sustaining giants. Member-owned clubs like Real Madrid and Barcelona have limited access to external equity. Like Barcelona's use of financial levers, they will increasingly rely on dangerous financial engineering to survive the competition. Tier 3, seller clubs. The remaining clubs will likely devolve into satellite teams within multi-club ownership structures, functioning merely as farm systems that supply prospects. Third, the exit strategy, the greater fool theory. The final question concerns the exit. Firms like Clearlake or Redbird must eventually sell to realize returns. If they bought Chelsea for $4 trillion, they need to sell it for at least $6 to $8 trillion to succeed. The problem: there are very few buyers globally capable of paying $8 trillion for a football club. The conclusion is that the only entities capable of absorbing this price are sovereign wealth funds. The risk: if oil money loses interest or is blocked by regulations, these PEs may face a blocked exit, forcing a long-term hold. In this scenario, they would shift focus from competitive performance to extreme cost-cutting and monetization, likely leading to severe conflict with fans. Part 6, Conclusion, the Syndicate's Note. Football is no longer just a sport. It is a tradable asset class. Through this session, we have seen the true face of the capital infiltrating European football. Some aim to grow the club and sell it high, the builders. Some use debt as bait to swallow the club whole, the sharks. And some attempt to own the league platform itself, the aggregators. While fans cheer because their team won a match, financial capital quietly smiles because their portfolio value has increased. Moving forward, when you watch European football, look for the capital tag hidden behind the players' jerseys. That tag will tell you the destiny of the club more accurately than any match result.